All right, good evening. It's 6 p.m. in WA and 8 p.m. in the Eastern States. So very good. Welcome. Hoping you can hear me okay. Patrick, if you can give me a thumbs up if you can hear me okay. All right, beautiful. Well, welcome to this property education webinar. Tonight's topic, as you can see on the screen, the property market update and property tax tips for the end of the financial year. We've got some excellent presenters this evening, Patrick Thatcher from Thatcher Consulting and Jamie Horner from Empire Property Management, as well as myself. So let's get cracking. He says, right, let's go. Okay, right, okay. First of all, disclaimer. So please just have a read of that. The information tonight is very general in nature and is not relevant to anyone's specific circumstances. We're happy to talk to you one-on-one afterwards to give you very special and individual circumstances of advice, but this is just general and educational. Right, so Property Powerhouse is the host for this evening, and I am the CEO. My name is Garth Davis, and my role is I'm the founder and CEO of Property Powerhouse. I'm also a real estate licensee in WA as well as Queensland. As of last year, I became a director of PICA, which is a Property Investors Council of Australia. We are a voice and representing property investors around the country. We represent investors when it comes to all things like legislation, and when the state governments try to implement changes, Residential Tenancy Act changes and things like that. We're a voice at the table representing the property investors and the investors' rights. Also a member of the Property Investment and Finance Committee of the Property Council of Property Council of Australia. So been on that since the beginning of the year, trying to give back to the community. Also very involved in Real Estate Institute of WA and in Queensland, involved on those committees as well. So yeah, I live, breathe and eat property, investment property, and love it. Our business, Property Powerhouse, as you can see on the screen, we provide education, support and experience to enable mum and dad investors to buy quality properties all around Australia. So that's what we do day in, day out, and provide education like tonight's event. So what's been happening? Right, well, as of today, the big news, as you know, we've had another interest rate movement today, another 0.25. So since May 2022, it's a year, we've had 12 consecutive interest rate increases. So we've been hammered, and it's obviously going to be in the news and in the paper. And even part of tonight, we're going to try and understand how do we work with that. You and I cannot control interest rates. So how do we work with it and overcome that? The RBA, Reserve Bank of Australia, the cash rate now 4.1%, the highest since 2012. All right, we're in an environment of very much increasing property demand as far as, and this goes right around the country, as far as buying and as far as renting is concerned. So very strong demand for buying and for renting. Increased migration, so 700,000 people coming to Australia over that sort of 2 to 3 year period. So we're really short of properties, we're really short of properties to rent, as you'll know, and increasing another 700,000. Where are we going to house these people? That's the big question. All right, we have decreasing property supply. Even here in Western Australia, we've got our biggest builder, BGC. They're so inundated with work since the grants and the government bonuses that they're actually not doing any new builds at the moment. So we have a decreasing supply of property, increasing migration. So we've got more people wanting less property. So what's that going to depend on? And decreasing rental supply. In some of the states, we've had investors selling off, and those properties are being purchased by owner-occupiers. So decreasing properties to buy, decreasing properties to rent out. So yeah, there's a lot going on in the property space. Right, let's try and get to the next page. Right, inflation. So yeah, last month we were 6.3, jumped up again to the latest data as of last month, 6.8, resulting in the Reserve Bank lifting the interest rate again today. Let's have a look what's happening with property prices around the country. So this data is care of CoreLogic. They produce this table the last day of every month, which is always very interesting. So down the left-hand column, we see the capital cities. First graph is the percentage change in the median value over that period, right? Then we have the quarter, then we have the annual, and extreme right is the median values, right? So as we expect, Sydney right at the top, followed by Melbourne. It's very interesting to see the turnaround. So, you know, up until about 3 months ago, most of the capital cities were trending downwards. They were losing some value after having a very good run, but they've taken a sharp, swift around turn, and that's basically on the back of very, very minimal supply. In Sydney, 1.8% over the month. Well, that has actually been driven by the upper quartile. That means the upper quarter, it means the high end of properties. So they're not getting massive volumes of sales, but the sales are getting at the top end. So, you know, by increasing interest rates, these are probably the people that you're not going to affect, because they probably have, you know, these are the people that are buying the properties in the 2.5 million plus sort of space. So they're driving the market, and unfortunately, they're probably less sensitive to interest rate movement. But really good to see what's going on. All capital cities are going positive. So it means all, you know, again, supply is tight, demand is high. That's what's pushing prices up. The 3 cities that were above 1% and above: Sydney, Brisbane, and Perth. And as you can see over the quarter, Sydney going well, Perth going well. So yeah, all positive signs for properties as far as capital growth is concerned, right? This is the same information, just presented slightly differently. And what we can see here is the more affordable capital cities, and particularly of interest in our research and Property Pass is the Perth market at the moment. We see very good value in this market, as well as the rental yields, which we'll explain in a second. So some good information there, just shown in a slightly different way. Okay, so let's talk about investing and what investors should be doing. And there's different ways to try and make money or do well out of property. You can buy and flip, renovate and flip. You can try and buy for cash flow. The strategy we have here at Property Pass is to buy and hold a property for long term. In our experience, and most people will agree, if you can hold a property for 15 to 20 years, you're going to do very well and be very successful. You know, and some people aim to hold a property that long, but end up selling after a much shorter period of time, within 3, 4, 5 years. And we'll explain why that happens. It's not the intention. The secret to being a holder property long term is the cash flow. So we're buying for capital growth, but the real secret and the key is around the cash flow. I'm going to talk a bit about that tonight, especially when interest rates now have moved up again, and they are going to have quite a significant bearing on whether you're successful or not. Sufficient rental yield, so you can pay your costs along the way. And what is sufficient rental yield? Well, we've got to be buying in the right areas that allow for really strong rents. With investment property, we've got to understand that cash flow, we have income coming in from the rent, but we also have access to depreciation and tax savings. And that's where we'll be talking to Patrick Thatcher tonight, our property tax accountant specialist, about how can we use those things to help with our cash flow. And at Property Pass, we recommend buying new. That's our strategy. So you can sleep well at night, not having to worry about unknown costs and expenses that could jump up through any repairs and maintenance. New properties will have a minimum of a 7-year structural warranty. And also they will have the warranties for all the appliances, the plant and equipment inside. Let's have a look at some yields, and I'll explain in a moment what yields mean. But the national yield is around, what we need to equate this to is interest rates are probably going to be around, they were about 6%, 6.1% before the interest rate movement today. So we're going to be looking at about 6.3 for an investor loan. And we need to be understanding how the rent, the income coming in from the property is going to affect that. So rental yields, I'll explain in a moment. The higher the number, the better. So we can see in Darwin, which we circled, has got a 6.4. Perth has got a 4.9. It goes right down lower, and it's to do with the price of properties versus the rent coming in. So the higher the number, the better, right? So Darwin, Perth, strong. then Adelaide, Canberra, where we got Hobart, Brisbane, OK, Melbourne and Sydney, the rental yields are low, which affects cash flow, which means you need more cash to fund those properties to be able to hold them. Right, interest rates, well, this was up and still current up until today. So assuming it's an investor loan, so we're taking out an investor loan at an 80% loan to value ratio, which is what most loans are, interest only. The variable interest rate 6.14, that will be going up. I'm sure we'll hear the banks in a nanosecond saying they're going to pass on the 0.25. We did have a 1-year fixed below, a 2-year, you could see it 5.79 and a fixed at 5.74. So what was interesting is what that tells us is the banks are expecting the rates to come down, and some economists are even forecasting as early as the beginning of next year. They think that the Reserve Bank has gone too hard, too quick, and actually the rates will start coming down at the beginning of next year once people have really stopped spending and the economy starts to slow. Right, let's go to the next slide. Okay, so what is a rental yield? Right, let's go one at a time. So let's assume the rent on a property is $500 a week. Purchase price, let's assume it's $500,000. The rent per year, we take the 500 per week times 52, gives us an income, gross income of 26,000 per year. To calculate the rental yield, the annual rent, we take the annual rent, we divide that by the purchase price of the property, which is 500,000. It gives us that 0.052 multiplied by 100. That gives us a rental yield of 5.2%. So just for a rule of thumb, dollar for dollar, a $500,000 property that rents at $500 a week is 5.2%. Now, in that last slide that I showed you, we had Melbourne and Sydney really, really low with a 3 in front of them. We had Perth with a 4.9, and we have a Darwin with a really strong rental yield. So that is what we refer to when we refer to a rental yield. I'm going to run through your case study. This is live. This property settled last month here in Perth. It's a picture of the property, and I'm going to explain to you through this now. Purchase price of this property was $505,000. Brand new property, 3-bedroom, 2-bathroom, double lockup, standalone. It was 9 kilometers north of the Perth's Central Business District, CBD. Purchased by one of our Sydney-based investor clients of ours. This property settled in May, so as in last month. The investor anticipated, and we'd forecast a rent of $500 to $550 per week. The property was put on the market at $550 per week as soon as it settled. Within 3 days, the property was signed up at $650 a week. So $100 more than the highest we anticipated for the client, right? That was giving a rental yield of 6.7%, which is fantastic, all right? So we are comparing this with a general median rental yield in Sydney of about 3.2%, and in Melbourne of about a 3.7. So this yield is really good. So strong cash flow, capital city, not in whoop whoop, 9 kilometers from the CBD only. Okay, good property for capital growth, being so close to the CBD, near schools, near employment, and this property will create very good cash flow. So not only do we have the very good rent amount per week, being brand new, we get the tax savings from the depreciation, we get the some tax savings from the interest paid on the property, and we can sleep well at night because it's a brand new property. So the reason for showing that is, even though the interest rates are going up, it doesn't mean that you have to go in your shell and you stop looking. In fact, it creates more opportunity for you because there is no supply. There's no supply. Demand is high. People are migrating. If they can't rent a property, they're going to buy a property. So property prices are still set to keep growing, and the only solution will be supply. And the supply is also difficult for builders at the moment. They're short of trades. As I said to you, in a market like Perth, well, our biggest builder in Perth is not even building until they can catch up. So supply is not going to come right in Perth or Western Australia for probably at least 3 to 4 years. and yet the demand is coming. So we want having more people wanting less property, right? And so prices we see going up, and we also see the same thing too, is that there's no rental stock. And in fact, you'll hear from Jamie a little bit later, Jamie Horner, that rental supply is actually going backwards, which is great for landlords, but very not a good scenario for tenants. So that's my quick wrap up of what's going on around the country, explaining around cash flow, which is really, really important now. My advice to you is get hold. When you see interest rates moving like they are, the first person you need to get hold of is your finance broker. Have a chat to them. Have them have a look at your scenario. Are you on the best interest rate? Are you on the best loan? Should you be variable? Should you be fixed? Should you be refinancing to another bank? So it's really, really important that you're talking to your finance broker. Really important also that you're talking to your accountant so that you can understand and take advantage of your opportunities. So that's it from me. I'm going to now hand you over to Patrick Thatcher. So Patrick, you're up there in the corner. I think you're going to mute yourself now. I'd like to introduce Patrick. He is the director of Thatcher Consulting. So Patrick is an experienced business and specialist taxation advisor focusing on the SME market, particularly private clients and high net worth clients. His 20+ years of experience in the industry, both as a business owner and a senior tax advisor, has shown the passion he has for assisting his clients to grow and maximize their wealth. His main purpose is to provide his clients with certainty in an uncertain world. Patrick has offices in Perth, Kalgoorlie, but assists clients Australia-wide. Over to you, Patrick.
Thank you, Garth. Can you all hear me, Garth? Is it clear?
Yeah, you're a little bit muffled, so maybe just talk with your strong voice there, mate.
I do have a strong voice. So yes, thank you for the intro. Property and taxation is a very popular topic at this time of the year. As we approach the end of financial year, everybody wants to maximize their tax or minimize their tax position and maximize their deductions. And property provides you with that sort of overall deduction to help you with your tax position. So what I'm hoping to do tonight is to give you a bit of a rundown of what to expect in terms of, if you're a property investor, what sort of things you've got to keep in mind, what does negative gearing mean, and what you should be focusing on if you're in a negatively geared property. But before I jump into that, I wanted to touch base on a topic that is very, very on the agenda at the moment. That's the discussion between whether you buy a new property or you buy an existing established property. Now, I'm not a rental property specialist from a market point of view. I only dabble in the tax side of things. But from what I know, and I've had properties myself and the research that I've done, that's pretty much the summary of new versus established. I wanted to put some points on slide for you, just to highlight some of the advantages and disadvantages of buying new versus established. So if we jump to the new properties, as Garth has explained from his statistics, new properties are the properties that have the asset value and the growth potential. It's been proved time and time again, if you buy in the right area, if you buy in the right location, the value that you pay for the asset is held, and growth is delivered further down the track. And this is long-term growth, not short-term. The biggest advantage with buying new properties is the tax deduction that you can get through depreciation. Now, the government has announced, and as of the 28th of April of this year, that they will increase the deduction on capital works. So capital works is depreciation on your building write-offs. So your building costs, in prior years, you were able to depreciate building costs at 2.5%. And now they are increasing that to 4%. So if you take a $500,000 build, for instance, at 2.5% is about $12,000 per annum at play. If they increase, well, when they increase that 4%, that'll jump to about $20,000 per annum. This is on a $500,000 build. So if we're focusing on tax deductions and making sure that we maximise our deductions to get back as much refund as we can to help us out with our investment, new properties will deliver that and will go a long way delivering that part. So with new properties, there's increased tenant appeal. The newer the property, the more higher the rent you can dictate. These days, with rental market, you put a property on for rent at 500, and you will be very unlucky if you didn't get at least $50 or $100 more than what you're asking, because the competition in getting into the rental property these days is very fierce. So the newer the property, the more chances you will have to command a higher rent. I've mentioned the government incentives. There are a few incentives. I don't want to go through all of them, and you will have my email address and contact details if you're specific to wanting to know what those incentives are. I can actually share that with you further down the track. So if we go to established properties, if you buy an established property, you will be dictated by your budget. So your budget will dictate what location you're able to afford. If you have a low budget, you will probably be in a low sort of property value area, and it could be outside of the 5 to 10k circumference around the city, which means that you will be faced with growth issues and potentially high renovation costs. Whilst it's tax deductible, you will not be guaranteed a growth pattern for that property. So as far as established properties are concerned as well, your depreciation deductions are also a lot lower than your property. Garth, if you can switch to the next slide. And again.
Patrick, just to let you know, it's still a little bit fuzzled your voice. So if you can just talk up a bit, that would be brilliant. Thank you. Just getting to your next slide. There we go. Yeah, there we go.
So the disadvantages, and I'm going to clarify this one. You have different type of new properties. Properties that are priced to market on, once they're sort of completed, and also properties off the plan. Now, I'm not an expert in that side of things, but from what I've researched, the off the plan properties can sometimes be put at a premium price. And this is because obviously developers estimate certain market valuation to be, to be set on those properties. In a good market, these properties can hold their value, but in a downturn market, the property valuation can actually decrease. And that can be a problem for banks, because banks obviously depend on market value. And you may be missing out on good quality property if that valuation drops. Your cash flow may support the property valuation. And also, main thing with land properties is that the finishes may quite often differ from what you actually get. From what I hear, Garth is promoting properties that are already built, already on the system, and you actually see what you're buying. So, the new properties here that we're talking about not necessarily the one that GARP is promoting. So as far as established is concerned, the disadvantages there are the hidden problems, the things that you don't see. So if you buy an established property, you will do your building inspections. It's not very often that you get the full report that shows certain problems. Those problems can be quite costly at times. The difficulty of getting renovations done these days because of the trades aren't available. I mean, if big building companies can't get trades, genuine builds, just imagine your chances of getting renovations done. But the biggest disadvantage with it is lower depreciation function. If you're focused on negative gearing and you're wanting as much deduction as possible to help you out with your maintenance costs, established property where to go as far as I'm concerned. All right, so let's go to the next slide. Yeah. So what is negative gearing? I'm sure a lot of you already know what negative gearing is, but for those that aren't familiar with it, so you've got to understand what it's going to create before you get into it. Because negative gearing is losing money, but you lose money for things that will generate a return in the form of a tax refund. Now, owning a property and negatively gearing the property is, for the first few years of ownership, quite advantageous because you earn a decent income, you pay a lot of taxes, so that negative gearing component should help you get some refunds from the tax office. That refund can then be placed in your property portfolio's cash flow and assist you with paying some bills and maintenance costs and then carry the property for you, along the way. So is it for you or is it not? Let's find out. So Garth, if you can click that one there and the next one. So in its real form, negative gearing is a form of financial leverage. So basically you're spending a full dollar and you're only getting 30 or 40 cents back. But the 30 or 40 cents back reduces the amount of tax that you pay and delivers a refund. So how do you achieve that? When you borrow funds to buy the assets, that investment, that cost of borrowing funds becomes a tax deduction for you. And it's when the cost of holding the asset exceeds the income generated. So when your total operating cost of that property exceeds the rent that you've received, and it creates a loss in that property holding, that loss then is used to offset your other income that you've received during the year. And that's how you then get a tax refund. So that's in a nutshell what negative gearing is. So what you need to be aware of, so negative gearing is used to subsidize your property ownership. So it's never going to refund you dollar for dollar expenditure on that property. So the tax benefits that are available through negative gearing will, as I said, lower your tax bill or deliver refunds. So with that in mind, you need to be aware of how to maximize your tax deduction to make the most of negative gearing. That is the key. That is the trick. And we all know that we never go into an investment to lose money. And the aim of the game is to hold the investment for a longer term and very slowly what started as a negative asset will become a positive asset because you are reducing your expenses year on year from the first year onwards. By the time you get to year 10, 11, or 12, sometimes earlier, depending on how much you are paying towards owning that asset, your income, which is the rent, should increase on a regular basis, and therefore you're turning the asset into a positive investment. That's the aim, and obviously holding the property for a 10-year plus period will definitely, and if you bought the property in the right location, definitely generate growth in the asset value. So the double whammy is turning the asset into a positive year asset, and two, achieving growth in being in the right location. So let's have a look at some of the stuff that you need to be aware of as a property investor. I'm sure you'd all be familiar with those deductions, rates and taxes, council rates, water rates, and other local government taxes that you have. The insurances, so your building insurance, your landlord insurance, your repairs and maintenance costs. So be very careful with those, because it is a very fertile hunting ground for the ATO. Repairs and maintenance. There is a distinction between capital repairs and general maintenance costs. Now, capital repairs are those when you replace your stove, air conditioning unit, hot water system, all those big ticket items. You need to depreciate that. You can't actually claim the whole lot as a deduction. But general maintenance costs, restoring an asset to its original value, or cleaning costs such as carpet maintenance or a fresh coat of paint, that if it's termed properly, you can claim 100% of that cost in the year that you've incurred it. Property managers' costs, definitely for managing the property. Depreciation is the best way to do this is to get a depreciation schedule done by a quantity surveyor. There are several out there which I'm sure Garth can recommend. They provide you with a report that has a 40-year deduction schedule. Us as accountants go straight to what we don't even try and calculate the depreciation because it's a minefield. Quantity surveyor does it for us. We're happy as Larry. Then your accountant's fees, of course, and that's not just your annual tax. Consult an accountant during the year, and you have queries about whether or not you can claim certain things, or you want to buy another property, which name to have it into, some structural advice from the accountant. That is a deduction. So make sure that you account for all of that. Advertising costs, pretty straightforward. Strata fees. Now, strata fees, you've got to be careful because there are some capital costs that are taken into consideration in the strata fee. So if you are providing for a future cost, that protects this as a capital cost, so you can't claim that straight away. So be very careful. Your strata fees to make sure that these are ongoing costs. There's an ongoing cost factor in there of built-in capital costs. Land tax, very straightforward. Interest on loan, that's probably your biggest ticket item. With the increase in interest rates, that will deliver some fairly hefty interest on loans. And if you can use all of that to reduce your income, increase your losses, you should be getting a very tidy refund to help you with property. Next slide. So end of year tax tip. Make sure that you are aware of all your deductions. And if you have a choice of paying your deduction before the 30th of June, make sure that you do that, because the time is everything. If you pay it in next year, you cannot bring it into this year's tax bill. So I would go through all my expenses, make sure that I tick all payments, make sure that all payments are done before the 30th of June. And this will ensure that you deduction that you legally allowed to have. Now, the next one is a deferring of income where possible. So if you have a rental property that is generating high rent, and there's potentially a tenant that says to you, well, I want to prepay next year's rent, just to be ahead of the next person that wants to bid for the property. Be very careful with that, because you will have to declare that prepaid income in your tax return. So instead of being the $20,000 or $25,000, you may end up with $50,000 in your tax return, and that will completely eliminate negative gearing position. So yes, it's good to have the cash in your bank account, but be aware that there is a tax bill and waiting for you if that is the case. Make sure you gather all your receipts, prepare your spreadsheets, schedule, whichever prepare, and make an appointment to see your accountant early. The earlier you lodge your tax return, the faster you will get your refunds. And the stats is point to, if you lodge your tax return in the first month or two, you are the first ones off the ATO's rank. Pretty straight. And the biggest advice I can give you guys is to make sure that you have a good accountant, one that understands property taxation, because these days the ATO and their audit activities are very, they're very on the ball. And if you try and do it yourself, they get it right, they get it wrong. If you go to an accountant that doesn't specialise in property, you may have the ATO knocking on your door, and that won't be good. So that's me. Any questions? I'll leave that up now. And for the rest of the presentation, and got any queries, questions. Thanks, guys.
Thank you very much, Patrick. Well done. Sorry, some brilliant content in there. So thank you, Patrick. Sorry if it was the volume was a bit soft, guys. We did do an audio check. I'm not sure why it might have been a bit soft, but thank you for very much for that, Patrick. Guys, there is a Q&A bar. There should be a bar that you can reach out to. If you've got any questions, please type them in there. We might not be able to answer them all live, but we will definitely get them answered for you. We will be supplying contact details for Patrick, his phone number and his email address, and he welcomes any inquiries, and the same will be for Jamie, so our next speaker. So thank you very much, Patrick. Really interesting information. I've known Patrick as a tax accountant for property for 20 years. He's one of the very best in Perth. He has a boutique business, so the great thing is you'll be talking to Patrick and not, not 17 people down the line. So reach out to him. He's extremely knowledgeable. He's seen many property cycles, and he's very good at what he does. So thank you, Patrick. Right, let's move on to the next slide. Right, our next presenter and final presenter for the night is Jamie Horner. A few of you might know of Jamie. She speaks on our webinars quite frequently, and that's because she's such an expert. So Jamie Horner is a director at Empire Property Management in Perth. Her question is, how do you become a long-term successful investor that is ready for a life of relaxation? She says it's all about your team, and I second it. Jamie has helped more than 1,500 owners for more than 20 years acquire, build, and hold their own property empire through investor-focused property and strata management strategies. So not only a property manager, but also strata manager. She has a master's in property, Bachelor of Commerce, and a diploma in management in real estate. Jamie holds a wealth of knowledge and manages the Real Estate Institute WA Property Management Team of the Year at Empire. So that is fantastic. Jamie, a very warm welcome.
Thanks, Garth. All good on the audio. How are we going?
You're going beautiful.
Okay, perfect. I won't keep everyone long, and it's great news for owners in Perth at the moment. Not so great for tenants. So thank you, Garth. I do also work for the Real Estate Institute of WA. So We've been doing some tenancy training. It's a bit tough for tenants, but I think this graph says a lot. So this is Perth, and I think about my owners constantly. I'm an investor myself in Perth. And when I look at this graph, you can actually see that for anyone from 2013, 2014, that our owners really had 7 years of rents declining, which also meant price declining. Now, what you will see, however, though, from 2020 is this rapid rise. So one of them is rental price and the other one is days on market. Look, in reality, days on market in Perth at the moment is irrelevant. For a property that I advertise today, there would probably be 30 property people tomorrow wanting to take that property. So I think the key thing to see here, guys, is that you've got to understand the cycles. For a lot of my owners, that was really some tough times between 2013 and 2019. We were actually ready to go again in 2019, 2020, and then COVID hit and our rents got locked in for 12 months. So what you have seen is almost 1 to 2 years of rents that should have gone up that have now happened in that rapid rise between 2020 and 2023. So that, if you're ever wondering why is it so steep, it's going to continue to go steep. It's not one of those ones that's going to probably drop off. We're going to continue to climb on, most importantly, the blue dots. So the purple is the days on market. We will continue to probably, you see the blue bar graph, that will continue to probably maintain the same. The blue is your houses and the purple's your apartments. Apartments always lag a little bit behind, but you're going to see soon that because houses are so hot, the apartments are moving too. So, guys, that source is just REWA. And as you can see, unfortunately, March 2023, because June hasn't been released yet. But June, you're going to see the graph keep going up. Okay, guys, so let's have a look at some of the headlines. The very, very first image that I'm going to show you on the left is Perth beaches. So as you guys know, we have an unlimited amount of coastline. We have a huge amount of coastline. We have great weather. We have a very large, heavy population of people, just obviously in Asia across from Perth, which means that since COVID, since all of that time, people still want their open space and Perth doesn't seem so far away. So guys, look, these are just this week's headlines. We're right. It is considered a bit of a river of gold for investors at the moment. A lot of my owners are absolutely amazing. We're giving them how much the rent can go up to, and they're still actually going, oh, let's peg it back a bit, or they're falling off their chairs. Absolutely, building prices have blown out. A lot of our major builders have stopped taking new properties. Absolutely need more rents. And again, Garth touched on it, guys, it's supply and demand. Our demand continues to increase in Perth, and you'll see below, we're predicted anywhere from 20,000 to 80,000 interstate and overseas migrants. They're going to be fighting for 10,000 properties. So at the moment, guys, we've got about 1,500 visa approvals happening per week. However, we can't house the people that want to come here. The big one, we still are the most affordable city in Perth, in Australia. So everyone in Perth is feeling the pinch. However, when you absolutely compare Perth's rent and price, I think Garth had a graph up earlier, and you could see that other than Darwin, our median price is still the second lowest in Australia. So we're talking coastlines, big blocks, that space. I get it. We are on the other side of Australia, so we seem to do weird things over here, but we are a place that people want to live. I can guarantee you that stat is right, that there's rent up 178 per week. It's not 178, in per week in some suburbs. So it's only getting tighter in Perth, and there is no supply on the horizon. So we cannot at the moment manage builds. Oh, apologies for my slide. It looks like, I don't know if Garth can do a little bit of a, just delete that grey box if you can at the bottom. I just wanted to highlight 2023. But guys, in Perth, we currently, as of today's date, as of yesterday, have 1,970 properties, and that's absolutely dismal. 1,970 properties when you need 9,000 to 11,000 right now. What it means is prices keep increasing. So again, if you lived in Perth, you'd be saying, oh, my rent's gone up crazy. It's gone considerably high. Our medium rent is still $560 and our medium apartment rent is still $500. But you will see those numbers quickly climb up. So look at 2017, and it was a bit sad for our owners. They were the sort of prices that they were getting, 2011. We really we sort of pitted off and maintained that level. And then, like I said, from 2021 to 2023, we've gone on that upward slide. But that, guys, that big number you need to look at is 1,970. Every single month that we continue on, that number of houses we need just keeps going up and up and up, and we just can't build them. So next slide, Garth. Okay, now guys, the big thing that I do need to talk to you about, because the Perth market in the last 3 years is crazy and we're only going up. We cannot build them. So if you want to get an approval at a house built at the moment, we're now looking at 2.5 years. We're looking at for immediate crisis care in relation to people who need public housing, that wait list is now 3 years, and those on normal, we're talking public housing and now looking at an average of about 11 years. So our government's commitment even to them, it's not going to be met for a long time. The biggest thing that Perth has had announced in the last 2 weeks is our rental market reforms. And as a REWA employee, I can tell you that in relation to this, it was the uncertainty that was the problem for a lot of owners. They've seen what's happened in other states and they're worried about what's happening here. I have highlighted a big one in green, guys, because this is the biggest win. We didn't expect to have this win, but we wanted to maintain no grounds termination. Great news in WA that we have absolutely had the ability to. So it means that when your tenant comes up to the end of their lease, you still have the ability to decide to buy, sell, keep, renew. No grounds termination has come off the cards, so it's an absolute win and probably the biggest one. So the ones that have changed, owners can increase rents every 12 months. Perth is one of those absolutely lucky states where we could actually increase rent every 6 months. Now, again, a lot of our owners are going, oh, so now it's every 12? As a property manager, I'm a firm believer you sign a contract for 12 months. I think we should be able to set that price for 12 months. And we also have the ability to look at the market rent, look at the future rent and negotiate that correctly. So again, we were just one of those lucky states that had 6-month rent reviews. Even if you signed a 12-month lease, we were able to look at your rent in the middle. So we're going to go to 12. The changes will need to pass Parliament, and they're still not expected to 2024. This is the big one, guys, that people feel a bit odd about. The tenants will be able to have pets unless there are grounds otherwise. And then the pet bond will have a review. Now, as owners, I get it if a pet is not suitable in your property. Large dogs are still not suitable in small apartments, all those sort of things. However, for a lot of my owners, I've always been pets considered. We are a population in Australia of 73% of people having pets. It's a big number to outrule. So I think, guys, it's time to embrace it. I personally have 3 boys, so I can tell you that the damage that 3 boys does compared to a well-loved pet, there's a big difference. Tenants can make minor modifications, guys, and this is not the end of the world. This is sort of that whole, I'd like a Foxtel point. I would like picture hooks, all the things that make something a home, and then they will need to return those at the end of their tenancy. And we're going to have an amendment to the bond dispute. The bond process is a bit of a pain, I should say, in how the property was left at the start. This is coming out of the court's hands and we're going to be working with Demers. So We're pretty lucky in WA, guys. Our proposed reforms were looked at 2 weeks ago, and we've come up with some really, really big wins. It's great certainty for my owners. And now, because it's probably not going to come through to at least 2024, we've got some great time to factor all of those in. Okay, what have we got, Garth? I think are we going backwards there?
Probably.
So, yep, here we go. Oh, 6:50. Perfect. I'm running on time. So, guys, key factors again. This is economics, demand and supply, right? So, the number of rentals has fallen by over 5,000 in Perth over the last 12 months. So, guys, why? It's because for a lot of my owners that bought prior to 2013 or after 2013, they've finally got there, but they've only actually just got back to close to their purchase price. They really need to wait for that next growth cycle. So guys, 19,000 since 2019. So guys, what that is that supply is absolutely fallen off. As you can see, we can't take 19,000 properties out. If you're wondering how we get that stat, guys, that's from the bond administrator. That's the number of bonds available. So by 2023 to 2027, so now over the next 4 years, we will have a shortfall of 25,200 properties. That's a low estimate, guys. We remain the most affordable state, and as you guys know, we have a lot of mining, which means that people want to work here. The actual wages compared to what they're actually paying in rent, we only hit 560 per week, guys. So it's a very affordable state to live in. I've already talked about our beautiful beaches and weather, and we have an extreme labour shortage. So for the first time in WA's history, we now have 1.5 jobs for every unemployed person. Even if every unemployed person in WA got up and got a job, we still wouldn't have enough. It's why we are attracting migration over here. It's why wages are going up, and it's why we're a popular place to come to, because you've still got those very affordable rents and purchase price compared to the rest of Australia. Like I said, guys, we're looking at 1,500 visa approvals per week, and we have a very low estimate of 1.7% population growth in WA. That's 46,000 people. Now, guys, if you do remember, we have 1,970 properties in Perth and 46,000 people expected, let alone the people that are here. So guys, where's everyone living? You know homelessness, and Garth is doing the CO Sleep Out to support homelessness. So I'm going to segue to say, look, get in and give Garth a support. It's still a very, very key thing that we've got to talk about. But people at the moment want a rental, but they're staying with their parents. They are house sharing with multiple people. So the demand is actually higher because, yes, for all of us who have those older kids that we want to kick out of the house, they don't have somewhere. So guys, even the figure of a 25,200 shortfall, it's probably not a true indicator of demand. In WA at the moment, so last month, for every 10 properties I have available for rent, we average 1,300 inquiries, 700 people attending home opens for those 10 properties, and we average anywhere from 19 to 30 applications per property. So they're the scary figures, and our building approvals at a historic low in WA. So we are not applying, we're not building them. It's only going to force our rents up higher. But still, guys, even if our rents went up 10% over the next year, our average rents would still be 600. It makes us extremely affordable, but it also means that for the purchase price that you're buying in Perth, your yields are looking even better. So thank you, Garth. That example was a property we rented, and we expected 550 per week. And 650 is just the market at the moment and only getting crazier. So thank you. That was my very quick summary. I will leave it for there's any questions.
No, that's brilliant, Jamie. Thank you so much. I'm just looking, guys. Please use the Q&A chat box if you've got any questions, because we've got about 5 minutes. So my team and I have done an exceptional job. We're normally running a little bit late, but so there should be a Q&A panel if you've got any questions. I'm going to, while we're waiting for any questions to come through, I'd like to maybe ask Jamie. So Jamie, what are we finding with investors at the moment? Are you finding like the investors, the new investors that you're getting on board, are they generally Perth based, or you're getting a lot of interstate?
No, they're interstate, Garth. They're using buyer's agents here definitely just to make sure that they can source the right property. But I'll give you an example. For someone that lives in Perth, we still get sometimes caught up in a suburb's location and name. I'll give you an example. I had a property manager that recently told me that Balga is now called Baljet because people in the eastern states look at that suburb and say to themselves, and I laugh because I still think of it as Balga, they look at that suburb and go, it is 8 k's from the CBD. You are close to everything. You are north. You are this close to coastal. They look at how much the average price is and what rent they're getting. You just showed us a property in Westminster, and the suburb next to it, Yokine, is 50 meters away, and those prices are 100,000 more. So that in Perth, we get a little bit caught on our suburbs and our distance. Whereas people in the eastern states look at the fact that, you know, you can still buy a reasonable property, a beautiful property on a decent amount of land at $500,000, 8 k's from the, 15 k's from the CBD. So they are in Perth, historically, we've always jumped on after everyone in the eastern states has sort of worked out that we're the value here.
Yeah. No, well, I think that's excellent, and also probably a great opportunity also just to talk to a couple of Patrick's slides there. So Patrick had sort of highlighted, off the plan properties, and that's something that we don't do a lot of at Property Powerhouse. So off the plan apartments that are going to be taking 2 to 3 years to get built, that's something that is a no-no. So we tend to try and recommend new build houses, townhouses, or villas. And if there's house on land, if the land is titled, reason being for those is that we can, and if they're still getting built, they'll be very close to completion. As Patrick was saying, we can get them valued quickly, make sure that they value up, that the price point is correct, that we've negotiated properly, and do a good job of that space, and great depreciation on those new properties, as you mentioned, Patrick. So very good there, mate. So thank you. Got a couple of questions just come through, so let's have a look here. We've got Bob. This one's to Jamie. Hi, Jamie. Will a tenant have to let an owner know they are making changes to the property, or have a new pet, or do we find out at the next inspection?
Oh, look, Bob, I must admit, at the moment, I think people are hiding pets, and you can tend to work it out from inspection. We are still waiting for the regs to come out. So in reality, though, what they have indicated is they still have to ask for a pet. They still need to give us the age, the details, that sort of stuff as well. It's just your ability to potentially say no. So they do need to ask, and you'll still be limited by the number of pets you can have in a property as well. And then again, into relation to the modifications, yes, it is an ask. It is still I shouldn't say an ask, but a tell you, approve, go ahead kind of process.
Brilliant, thank you. And Eleanor has said thank you for tonight, and can she get a copy of the slides? So yes, guys, I will be providing a recording of this has been recorded. Yep, it's been recorded tonight. Just making sure it should be good. Yes, and we will share a recording of the webinar so that you can watch it and replay any of the certain sections that you were interested in. Also, I will be emailing you the contact details of Patrick and Jamie. They are absolute experts in the field. We work very closely with both of them, and multiple people like them around the country in their own states. Jamie, specializing in WA. Patrick is nationwide, so he deals with investors all over the country. But look, tonight's session was, as you can see, was fully educational. Nobody's tried to sell you anything. We're here to help you. We help you to educate you. We help to put this great team of people around you to try and help you make some good choices. And we hope from tonight what you've sort of picked up is, even though interest rates are on the way up still, and they move today, that there's opportunities because there's no supply. And the thing is not to get caught up in all the negativity. Talk to your finance broker, make sure you're on the best structure, the best loans, everything. That's the first thing. The second thing is, if you are interested in looking at investing, talk to them about how to use any lazy equity that you've got. What are your opportunities? Can you borrow? Can you get service on the loan? And then if you can, then start talking to us. If you want to talk about structure, how you should buy it, then talk to Patrick. You can find out if you want to buy in your own names, buy it in a trust, buy it through in your self-managed super fund, whatever that may be. And then, you know, we're going to need experts like Jamie to make sure that it's managed properly. What I will say about Jamie and her team are brilliant. And this goes for the property managers, our preferred property managers around the country. Their best work is really in the beginning when they are qualifying the tenants. They don't grab the first person off the street. They will really do the thorough, detailed research into those applicants and making sure they're trying to avoid as much trouble down the track by doing the right work up front. So Jamie does an exceptional job, as do our other property manager partners around the country. I think we're spot on time there. There's no other questions that have come in. 7:01. I would like to take the opportunity again to thank you all for listening in tonight. We will be sharing a recording, and reach out to us if anything we can help with. Thanks again to my presenters, co-presenters, Jamie Horner, excellent. Patrick, always wonderful to have your knowledge and brains trust. So thank you guys. We're going to sign off now. Thank you very much, and good luck with all your investing. Reach out to us. We're here to help you. Thank you.